Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you.
We have the opposite of gold fever right now. You said people seem to be scared of it.
Yeah, it's kind of interesting, and that's not that unusual, though. Last year, gold did very well. The gold stocks, of course, soared. They more than doubled from their lows of January last year into the summer, but then they pulled back 50%, and that pullback has people scared. But despite that, they finished the year up about 50% from where they started in 2016, and they were actually the top performing sector in the entire stock market, which is pretty amazing. But when you have a brand new bull market following a big bear market, which is what happened, the mining stocks fell over 90% from 2011 peak till the low that they made in 2015 and 2016. When you have a bear market that big that goes on for that long, typically it's followed by what will turn into a powerful bull market that starts with huge gains the first year, on the first rally, and then you get a long, drawn-out consolidation period. So if you think about the U.S. stock market, when it bottomed in March of 2009, it went up tremendously off that low. The S&P 500 went up like 30% in less than 6 weeks, but then it stalled out and went sideways for months, and finally went up a little bit more to the end of that year. But it spent lots of times where it would go sideways. If you think about the Dow right now, it of course broke out back in November after the Trump election, but it really spent 2 years drifting around before that breakout happened. So right now, with gold in the mining stocks, I think what we're seeing is the first consolidation period in what's year 2 of the bull market they're in. And those consolidation periods, they cause people to sell. They get scared on any sign of weakness and get out, and shares get transferred to the stronger hands. Then eventually, at some point, there will be a breakout of the gold stocks. They'll go up to their highs and beyond, and you'll have the next leg of the bull market. But one thing that has a lot of people concerned, and I'm getting emails and feedback about it and seeing people write about this, is the fact that at the moment, the mining stocks aren't really outperforming the price of gold. And last year they did that, and historically that's a good sign. You want the stocks to actually go up more than gold is when it's going up. But so far this year that really hasn't happened. At the moment, for instance, gold is above or right on its high of February, where the gold stocks are about 5% or so below that high. And that has people worried that they might be about to crash or something. But I don't think that's the case, because in the gold commercials market, the futures market, the commercials are the largest traders, they're the producers, they're the hedgers, and they tend to be correct. And when they go short big time, that is a big dangerous sign. But they're not doing that. They have a smaller short position as of the last report, which is last Friday, than they did at the lows of December. Well, actually, let me correct that. They've got one about the same and it's a little bit bigger. But the point is that it's almost the same. So gold's at a higher price, and that's when gold was at below 1,200. Was back in January. So that's really a positive sign for the price of gold. And it looks to me like we're really heading for a rally up to 1,300, probably 1,330, or maybe even the highs last year, or a little higher than that for the price of gold, despite the fact that at the moment the mining stocks are lagging. And I think there's an important reason that they are lagging. And that is what happens is when the stocks have a year where they vastly outperform the price of gold, they typically actually do lag for 12 months or longer. This happened in 2003. The mining stocks went up over 100%, and gold only went up like 20% in that year. And then they spent about 2 years where the stocks traded with gold or lagged gold, so they didn't have these giant gains. And they worked off that huge outperformance. And that's basically what's going on. You know, the price of gold did not double last year, but the stocks did. So they basically went up so much that they're working off that condition, and it's probably something that's going to take more months to happen. It could be into the end of the year or early next year, and then this will change and the stocks will start to outperform the metal again. That said, there are going to be individual mining stocks, though, that do, particularly in the junior mining world, where you've got small cap stocks that aren't really moved around so much by these exchange-traded funds, and they can trade on their own news and their own developments and so forth. So, you know, there's lots of opportunities here. It's just, you know, people are finding reasons to, I think, you know, to worry themselves, which is really typical in the second year of a bull market, where you do have the pause, you do have the consolidation period, that does tend to shake people out because, look, you know, these things are volatile. You had the terrible bear market where a lot of people lost money. You had a 50% drop last year. So the risks of losing money is still in the back of people's minds, and no one wants to lose again. Flip that around to the condition of the stock market, though, where it's gone up all year without only one day where it was down more than 1%. And people have forgotten that it can pull back or that you can have a bear market. And we haven't even seen a 15% drop in years. So when it comes to the U.S. stock market, it's the opposite, where no one seems to be worried. Everyone's piling in. In fact, in the first 3 months of the year, history has been made with more money flowing into ETFs in that 3-month period than any other preceding 12-month period ever. So we have two markets where the psychology is total opposite, a market where everyone is scared to invest, in a market where people are scared to not be in it. So that's where we are today, and it's an interesting thing to witness and participate in and be a part of.
We'll have more with Mike Swanson right after the break.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, how has the Russell 2000 been performing for junior stocks?
Well, it of course, following the election of Trump, it immediately took off. It skyrocketed. for about a month. But really since January, it's lagged the rest of the stock market. It corrected harder from the high made the day Trump gave his speech to Congress at the end of February, I think it was. The markets pulled back, the averages pulled back, the Russell led on the downside. So did the transportation average, but the Russell's made up of, smaller companies that, they just surged at first, but now not so much. And the same thing is happening with the bank stocks. So they took off. They really helped fuel the drive in the Dow with Goldman Sachs surging. Trump got some Goldman people into his administration, his chief economic advisors with Goldman, and he's got deputy national security advisor for Goldman. So there's a lot of, belief that he's going to help them out. But bank stocks across the board went up too, on the belief that there's going to be higher interest rates and help the profits of banks. I bought bank stocks myself, but I got out a couple days before that Trump speech, before the high. I didn't get out on the exact high, but a couple of days before it was made, because nothing can go up forever. And back in November, when the rally started, these stocks had PEs around 20 that make up the XLF, which is the bank stock ETF. It's got Goldman in it, JP Morgan, Bank of America, and so forth. But 1/3 of the stocks in the Dow are financial stocks. So this big rally in the bank stocks is really what helped to drive the Dow up as much as it went up. But now what's happened is those stocks took a hit last week pretty hard. Goldman itself had a down day in which it had the most volume all year. So there's signs that rally is probably done, and that is likely to cause the Dow to now lag the NASDAQ going forward here, just as the Russell 2000 is doing. The Russell, what really helped it go up was the conviction that when Trump won, that he would do infrastructure spending programs that would funnel money into small companies that do construction, that do transportation, and a lot of these type of companies are in the Russell 2000, not in the NASDAQ. And that's one of the things that helped drive the Russell up. But now there are doubts of whether he's going to be able to pass such an infrastructure program at the extent that was originally thought, which was $1 trillion. But now that health care bill, it failed, it didn't get passed, that's causing political commentators in the United States to doubt whether he's going to do $1 trillion infrastructure bill. And frankly, it doesn't seem very likely. So I think the bloom is off the Russell 2000 and the transportation average too, which also was poised to benefit from all this also by, having trucks and railroads transport all this stuff to construct things. Even his wall is in doubt in an article I read today, because they're having the next battle is going to be whether to or to do a deal about increasing the debt ceiling, how much more of a budget deficit can we do, and it looks like they might not agree to allow enough deficit spending to happen for the wall to be built. So we're in some interesting political times where it did seem like a lot of promise of programs to spend money to generate growth was going to happen, and now it doesn't look so certain, and it's, we don't know if we're going to get much spending at all in that regard.
We'll have more with Mike Swanson right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Mike Swanson. Mike, the NASDAQ is expected to have its best quarter in a long, long time. Why is that?
Well, I mean, it already has. We've seen the NASDAQ 100 really perform better than any of the other market averages from the start of the year on. A lot of the rally is being driven by Facebook and Apple and a handful of big cap tech stocks. The semiconductor sector as a whole is doing well, although there's a couple semiconductor stocks where that's not really the case. NVIDIA, for instance, was the top gaining stock in the entire S&P 500 last year, but this year it's a terrible laggard. But the tech is really where money has been flowing this year on the rally. It kind of switched. In November, December, it was bank stocks and stuff like the Russell. Now it's the big cap tech. Now that I don't really know how long it's going to continue, but it is a shift in leadership. And what I'm kind of interested in seeing is we're going to have earnings, another earnings season next month, the second half of April. And I'm really looking for signs that we're going to have a meaningful correction or even the start of a bear market in the stock market later this year. And the signs I'm looking for are things that precede corrections typically. And the number one thing I'm going to be looking for is the NASDAQ to continue to do well, the NASDAQ 100. But inside the stock market, for most stocks to underperform, to maybe even drop and fail to confirm the rally in the NASDAQ. And we're seeing that on the downside, but we're going to have to see if this continues next month during the earnings season. If it does, that's going to be a giant warning sign. And a similar thing, in fact, happened in July 2015, where the NASDAQ did really well that month during the earnings season, but the rest of the market was really bad. The internals, in fact, declined. The percentage of stocks above the 200-day moving average declined that month. But the NASDAQ was helped up by a handful of stocks. Facebook in particular that month did really well. And now, ironically, we're in a situation where Facebook is doing very well this year. It's leading the way, and so is Apple. So it could be, once again, just a handful of stocks. And if that's what this rally turns into, to put it to you this way, back in November and December, the rally was broad-based. It was bank stocks. It was the Russell 2000. It was the transportation average. Russell 2000 stocks. But now that rally is being transformed into a couple dozen stocks in the NASDAQ 100. So the leadership of the stock market is shrinking. That's what you see at the end of rallies, and if that situation does not change, that's going to be a giant warning sign that we're going to see a correction or worse. So we got to be prepared for that. It's not something that means the market's going to drop tomorrow or next week, but we could be in this transition phase. When these things happen, it's like slow motion, but you got to keep watching it week by week so you're ready to react, to lighten up positions, or even bet against the stock market. So that's a big situation I'm watching, and it's going to be interesting to see how it unfolds.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio on TalkDigitalNetwork.com. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.